Welcome to today's video. Today we look at the deal and valuation analysis when analyzing an acquisition of a company or when looking into a merger between two companies. Before we start, please don't forget to hit the subscribe button to get notified when we release new videos. The situation is that our intended transaction involves two parties. We have the target company, the company to be acquired, and the buyer, which is the acquirer. And now what we're going to do is either that we are going to purchase the shares from the shareholders of the target into the target. The two companies become consolidated together, and then only the shareholders of the acquirer remain, and the shareholders of the target will either receive cash and will go away. The other option is when doing a merger. In that case, we don't give the shareholders of the target cash, we give them shares in the acquirer's company. And then means we again consolidate the two companies together, and then we have the shareholders of the acquirers, but now they don't own 100% of the company anymore. They get diluted, and then we have to issue new shares, which will then be given to the shareholders of the target, and both will then own a stake into the consolidated company. The question now is how to analyze such a transaction, and we have developed a framework in 6 steps on how to do that. The first step is that we need to look at the target and its valuation on a standalone basis and just figure out how much is the company worth by itself. The second step involves that we need to look at the potential synergies created when we put the two companies together. These can be additional revenues we can unlock, or we can save some costs. And all this translates into value, which then can be attributed to synergies. The third step is that we need to decide how much we're going to offer to buy the company and how we're going to finance such transactions, either via cash, debt, or equity in the normal cases. The step number 4 is that we need to build consolidated financial statements, and we want to forecast the financials to see how this company on a consolidated basis then perform, what will be the financial ratios, how much debt will be on the company, what's the liquidity, what's the profitability, what's the EBITDA, so that we can understand in which direction this will go. And we also then have the basis for the next step, that we want to understand if we merge the companies first, what's the current value of the acquired today, where are we today, and then if we merge it together, the whole construct will be consolidated and will have a different value, and we want to be sure that the value goes up and it doesn't go down. So we want to prove that, and we want to show, and we also want to understand how much value this transaction can create post-transaction. Step number 6 is that we want to do scenario analysis. We want to understand what if the revenues are higher, the costs are higher, we have to pay more in terms of the purchase price. How will this affect the economics of these transactions in order to better understand the upside and then also the risks. Now let's look at the first step, which is we want to figure out the valuation of the target. To run this analysis, I'm using here one of our financial model templates. And in this template, we have one sheet for the target and one sheet to analyze the acquirer. I'm now here on the target sheet. And then what I'm going to do is I'm going to enter the historic financials, which is the income statement, the balance sheet. I will look at the cash flow statement, and then I will look at the breakdown of the revenues and the costs, direct costs and operating expenses. And then what I want to do is I want to do a DCF valuation, so I need a financial forecast. And in this case, also I have a 3-statement model. I'm just entering the assumptions by how much the revenues are going to grow over the next, in this case, 10 years. And this gives me then the revenues I can obtain. Then I will work through the gross profit, and then also after entering the fixed cost, the operating expenses, I will then also get up to the EBITDA. I have some more assumptions I can enter. We also have assumptions regarding the required net working capital, income tax rate, debt, etc. But more or less, that's all we need. We just need to enter the assumptions and build a financial statement forecast. We look at the financial ratios, if these appear to be realistic, especially also the ROIC, the return on invested capital, the liquidity. We just want to make sure that this forecast is realistic. The bottom line then is that we translate this into a free cash flow forecast. And now We will use, once we have that, we will use the unlevered free cash flows for our DCF valuation. We take the free cash flows as to the future, projected into the future, and then we will discount them to the present value. We'll calculate the enterprise value, and then by deducting the financial debt, adding the cash, we'll get to the equity value. So that's the DCF valuation. If we don't want to do it this way, or if you want another point to compare how this valuation compares to, we can also do a much simpler valuation. We just look at the company's EBITDA. Then we look at comparable valuation multiples we can observe from similar transactions. We have to do some research and we'll come up with a multiple. And then this will also allow us to do an evaluation of the company. And we collect all this, and if we now look through our analysis, we have projected, here in this case we can see there's a company where the revenues are growing. This has an EBITDA margin of about 17%. We look at the balance sheet. You see here the ROIC is going a bit up and down, but we expect this to stabilize a bit. We also see that this company should generate sufficient free cash flows. They seem to have just done some investments. And then what we want to do is that we want to compare the results of the different valuation methods. As I've explained, we look here at the equity value using the DCF method. Then we compare it, what would happen, which equity value would obtain if you would use the EV/EBITDA multiple valuation. In this case, it's pretty much the same. Another data point could be the equity book value, but normally this is not including the profit potential, so it's a bit less relevant. And then once we have that, we can then also compare it to whatever purchase price we're going to offer. And you can also see here the implied EV/EBITDA multiples. For this analysis, it's recommended not to only use one method, but also to cross-check the valuation with at least one other valuation method. Important here is that we, in the first step, that we only look at the company's value as it presents itself on a standalone basis for the moment without taking into account synergies. And that is one data point we need in our analysis. Now let's proceed to the next step of our analysis. That would be the evaluation of synergies. To analyze the possible synergies out of these transactions, we need to look at different types of synergies. So the first type to look at are revenue synergies. Are there any additional revenues we can obtain when doing these transactions? And we basically have to work through the sources of revenues, and we need to enter our best estimate how much more revenue could this create if we put the two companies together. This could involve that we could sell a product from target company to our existing client base at the Aquirer's company, or we can also vice versa, that we could sell products from the Aquirer to the customers of the target company, for instance. These additional revenues might also trigger additional costs, so we need to take this into account by entering the expected gross profit margins we can obtain, so that we can then translate the additional revenues into the gross profit contributions from those. Then on the cost side, many times there are also savings possible when acquiring another company, because we have two companies, we can merge some things together, or we don't need an office anymore, or other savings. So what we do is we have to go through line by line and just put down our estimates. How much will be the expected savings, and by when will these savings occur, so we can put this on our timeline. So now what we have done is we have entered the revenues and the cost savings. This will impact the EBITDA. So this means we have additional profit, but also to keep in mind, this additional profit will also trigger additional taxes. In addition to identifying synergies on the revenue side or on the cost side, it's also possible that there might be synergies related to net working capital. That means, in order to operate the business, that we don't need as much net working capital as if the business would operate on a standalone basis. In this case, we would also have to simulate this and figure out how much could be saved then in terms of net working capital. Another area to look at is in terms of investments. Both companies, if they are independent, they have a plan what they need to invest, but if we merge them together, they can use each other's resources. This means there might be some investments which are not required anymore, and this then also will lead to savings. We don't have to spend the money on certain things. That's an additional synergy we can take into account. And then to conclude, from these synergies, this means this has an effect on cash flows. We look at the free cash flows generated from these synergies. We also look at the terminal value from these free cash flows, and then we do the discounting using a standard DCF formula, and then we can calculate what's the present value of all these savings we can obtain due to synergies. The goal of our analysis is that we can quantify synergies as good as possible. Sometimes it's easy to do that, sometimes it's not so easy to do that, but we'll have to try our best. It's our best guess we put here forward. And then what we quantify are the effects on the annual results. But now if you're using our DCF approach, we can discount the expected free cash flows from synergies, and then we can actually analyze the effect on the company's valuation these synergies have. And this number we will then use later on when we look at the value created from this transaction. Now the next step is to determine the purchase price we are going to pay and how we are going to finance this purchase price. As we have determined in the steps before, we now know that the valuation of the target on a standalone basis is around 2.2 million and that there are synergies around of 1.9 million. And on the other hand, these synergies, they are specific to us, so we don't really want to share them with the seller because only we can realize them, and there is also risk involved in realizing these synergies. So we need to make sure that this value including synergy still leaves us enough upside so that we can create value from this transaction. In this case, what we're going to do, we are increasing the purchase price a little bit to 2.5 million, and then once this is done, we need to think about how we're going to finance this transaction. We have three options. Either we can pay in cash, we can raise some debt, or we can issue new shares to exchange shares for the shares of the target. If we pay with cash, we need to look at the Aquirer's balance sheet, and we see we have a bit cash, but it's just stretching it a bit. So this might not be a good idea to pay everything with cash. So what we do here is we can do 50-50 and we raise some money from the bank. And in this case, then this means we have a new debt facility. We also then will have to repay this debt facility, in this case over 4 or 5 years. And then this means post-transaction, we still have some money left, so that in case something happens, we're not running into a liquidity issue. Another option could be that we issue new shares. How does this calculation work? So we know we need to issue new shares in the value of 2.5 million. And now when we do that, we then need to look at the relative valuation between the target and the acquirer. So we need now to look also at the valuation of the acquirer. The acquirer's valuation is basically the same principle. We need a forecast, so we need to enter all the financials. Then this forecast will then result in a free cash flow forecast, and from this we can do a DCF valuation, or we can also do a multiples valuation, and then this will give us the data points to understand the value as of today of our buyer. In this case, we have DCF value a bit higher, the EBITDA multiple a bit lower. So let's say we do is a rounded figure. We just put this at 8 million, and because I'm doing this, I'm unlinking this from the DCF value. In this case, it's now an input, so I'm marking this in dark blue font color. So if we then look at, we have a value for a company of 8 million, we have 3,000 shares out, so per share we are basically offering, the value of our share currently is $2.67. So if we need $2.5 million to pay, the value of the share is 2.667, so this means we have to issue 937,500 shares, new shares, and this one will be given to the shareholders of the target company. So we have these three options. Now we just need to decide which one we need to do, and we can here simply toggle around. In this case, I'm going back to pay via cash and debt because I think that's more interesting. I don't want to basically get diluted with issuing new shares. Now that we have determined the purchase price, the next step is to basically prepare a consolidated forecast. And in this forecast, what we're going to do is we're going to add everything up. We're going to add up the financials of the acquired, the target, and the synergies. We're doing here this line by line. And important is for the income statement, we first need to wait the close, and we're only going to add everything up going forward, but not backward, because here we have a date when the transaction is closed. Until then, this is only the company of the acquirer, and then only from here on we start our consolidation. In terms of the balance sheet, this here will be a bit different. So that basically at the date of close, we start our consolidation, and in this case we add the assets of the target, This is a bit more tricky to do. So in this template, we have broken this down. So we basically look at the acquirer's balance sheet. We look which assets are going to be added. And then when we add this, start consolidating. So we have a purchase price to be paid. We have some goodwill to be created. Goodwill is basically how much you pay for the company's equity. What is the book value? In this case of the target, if we look at the balance sheet of the target, there is a book value, 1.27 million. So it means the goodwill is the difference between purchase price and equity book value. So we can here single out identify all the effects which will affect the balance sheet. On the liability side, we will have to eliminate the target's equity, because we only take the equity in this case of the acquirer, and the other will fall out due to the consolidation. And then we can also see the other effects. We have here transaction costs. If this happens, this goes straight to the equity because they're just costs. Then we have new debt financing. If we get debt financing, our cash position goes up, and this will then also impact the cash flow statement. So that we have here, these are basically the result of the transaction costs. We have to pay for the acquisition. This is net of purchase price minus the cash which comes with the target company. We then get some debt financing here, and with all this, then we can start our consolidated balance sheet. And this is what we're doing. So basically, all the accounts going forward, we then add this all together, and we model how the consolidated balance sheet will look like. And we can then also understand the new financial ratios, and we could also compare this. This is basically consolidated, means this is post-transaction, and if you want to compare how it would look like without doing the transaction, we can simply compare to the acquirer's expected forecast without the transaction. On the consolidated balance sheet, we can do the same in terms of valuation analysis as we did before. We can do a DCF valuation, and we could also do a multiples valuation. We have then a consolidated income statement, and now you can see that this will now look different to without the transaction. We look now at the revenue contributions. We can see that the target in this case is the bigger company. Then we have the revenues which are generated by the target, expected to be generated by the target, and then also the expected synergies. And depending on this breakdown, we can also understand a bit the risk, what is basically here the expectations and the assumptions. We then look also at the consolidated EBITDA. In this case, this is the second year post-transaction, so we will have the EBITDA of the target, we add the EBITDA of the acquired, and we also the synergies should increase the EBITDA, and then suddenly we actually have a higher EBITDA. We have in this case 1.4 million EBITDA of the consolidated company. EBITDA breakdown we also might want to understand. So post-transaction, where does the EBITDA come from? It comes from the acquirer, then the target, and then also the synergies. And sometimes it is different because here also the cost synergies are in there, so we can then also understand where we expect the profit to occur. We have a consolidated balance sheet, free cash flow forecast. Then now, because we use debt financing, what you can see here is that the debt EBITDA ratio goes up. In this case, it's 1.2. That's not too high. And then as we go and repay the debt, it gets lower. In terms of debt service coverage ratio, that means our free cash flow is more than 30 times able to pay the debt service obligation. So that should not be an issue at all in this case. Then what we also want to look at is the earnings per share analysis. Basically, we have here in this chart, we can see the EPS, the earnings per share pre-transaction, and then also the EPS post-transaction, which comes from the consolidated financial statements. As you can see, there is here a big difference. So this means that on a earnings per share basis, this transaction basically increases the EPS by nearly 70%. And in this case, remember we financed the transaction by basically cash and debt. So we have the same amount of shares. In this case, this also means that this transaction is pretty attractive for shareholders. Analyzing the valuation pre and post transaction is the next point on our list. We already talked about this, but basically we need the valuation of the acquirer. And we use, again, 3 valuation methods. And here we have either the enterprise value, which is darker, or we have the equity value. So using this model, it will give us the valuation of the acquired pre-transactions. In this case, we start here with the enterprise value. And then we want to understand if we add the valuation of the target on a standalone basis, this will increase our value. Then we have to pay for the transaction. There is a net amount to be paid, in this case 2.5 minus some cash on the balance sheet. So we're going down. So here we're not improving much. We have to pay for the transaction costs, and then again we have the synergies. In terms net of value, we can increase our company value from 5.9 to 7.9 million post transaction. Please also note there is still several assumptions in there. In this case, we are also assuming that the multiples are the same, but in this case it could also be that the multiple could increase if we could get a larger business. So sometimes there's some arbitrage here. Let's say if we combine this, we are in a larger category, our business is more diversified, it's more stable, it's more interesting for potential acquirer. And then this means we can also increase the terminal value multiple here. So we could even get to a higher valuation. And this waterfall chart just shows you how we get from the valuation today for the acquirer to the valuation tomorrow by basically adding the value of the target, the value of the synergies, but then deducting what we have to pay for the target net. If we combine this, what are the effects which further impact the value of the business? The last step of our analysis is to do some scenario analysis to figure out how this whole transaction might behave if certain things are happening. So what we want to do is we want to look at some of the key value drivers that affect the valuation of this whole construct. So let's say we want to simulate what would happen if the revenues of the target would be 25% lower. And as you can see, we have here a valuation of the target of 2.3 million. And then combined we get to 8.6. So now if I say the revenues are 25% lower, you see this has a major impact on the valuation. And that would be one of the risks here. Then another impact could be, we go back with revenue, but you could say maybe there is now a margin problem. Let's say if the profit margin would be 3% lower, you see this impacts the valuation, will also impact here the valuation. But another aspect could be what happens if, let's say, we have to pay more to acquire this business. So let's say our bid was not good enough, they ask us to revise it because they have other offers on the table. Let's say we need to offer 20% more. This means now the purchase price becomes 3 million, and you can see we're still making money here, or basically we're still creating value. But if we increase the purchase price further, you see we cannot go up that much. It's basically the value of the target stays the same, but we have to pay more and more for it, and then we can only create a little bit more value. And then this basically raises the question, what happens if that's really worth it to carry all this risk, or until what price we can afford to pay. On the other hand, we can also see what happens, let's say, if the synergies we expect do not realize. Let's say only 50% of the synergies can materialize, and then you see the value of the synergies is lower. And you can also see the gap here, the value pre and post transactions gets smaller, so there's less cushion in there. It still makes sense, but it's just not so attractive anymore like before. Then this could indicate that we should go and maybe consider lowering the offered purchase price. So all this we can easily simulate by either adjusting here the parameters here to quickly play around with that, or we can then also again go into the deal financing structures, or also revise the assumptions of the forecast or the synergies to basically figure out what is a realistic price and we can pay in order that this deal still creates value for us. I hope this video was useful to better understand how to analyze the acquisition of a business or the potential merger. If you liked this video, please give it a thumbs up. Please visit our website efinancialmodels.com. A link to the template used in this video is included in the description below. Thank you for watching.